Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by my company, Bull Realty. Hey, look, if you're looking to sell commercial real estate, land, apartments, or hotels, reach out to me. I will get you with the right group. My website is bullrealty.com, or you can email me at michael@bullrealty.com. A lot of my listeners tell me I don't talk about my own company enough. So there you go, listeners, and thank you for that. Well, we have an interesting show today. We're going to talk about the hotel industry, and everybody knows the hotel world kind of went into the tank during COVID. Well, how's it doing now? We have COVID really dissipating pretty well at the moment. Here we are at the end of the first quarter of 2022. Please welcome my guest. It's Ryan Meliker. He's president and co-founder of LARC Analytics and Research Consulting, and he's joining us on well, it's not Skype. What is this video system called here, Chase? Squadcast. We're on Squadcast. Ryan, thanks for being with us, sir.
My pleasure. Thanks for having me. Happy to be here.
Yeah, for all my podcast friends out there, try out Squadcast. So Ryan, as I mentioned, everybody knows that kind of the hotels went into the tank. Here we are into the first quarter. How are hotels really performing right now? Let's look at kind of the U.S. overall first.
Yeah, well, I think there's some good news. They definitely went into the tank. We saw a precipitous decline in 2020 that we had never seen before. Revenue per available room, or RevPAR, dropped 48%, almost 50%. And keep in mind that the pandemic didn't even start until mid-March. So a lot would have been much worse for the full year. Otherwise, we started to see things come back earlier in 2021 as things bottomed, in the first quarter of 2021 after the vaccines started to get distributed, which is encouraging. The good news right now is that we've seen some continued improvement. All occupancy, ADR, and RevPAR, all three core metrics, started to improve in early 2021. Through August, you even saw ADR and RevPAR actually recover back to 2019 levels and slightly above them in July of 2021. However, then you had the Delta variant in August and September, not to mention some of the leisure strength that we saw over the summer dissipate in the fall, and you saw RevPAR pull back below 2019 levels. Average daily rates remained above 2019 levels all the way until January of 2022, when we encountered the issues related to Omicron. Fortunately, as we've seen in February and March, Omicron seems to be in the rearview mirror now, and we're back looking at levels above 2019 levels for ADR, and RevPAR looks like it'll be there very quickly, which is encouraging. So overall, things are starting to recover pretty nicely. We are pretty optimistic for recovery moving forward as well.
Yeah, well, that's great news, Ryan. And I think a lot of us realize that the kind of the resorts, especially the drive-to hotels, really started doing well, and people are really anxious to get out there and travel again. But what about the convention hotels? Are they starting to show some signs of life?
They're starting to. It's early days. I mean, I think if you think about the recovery and how it's moved up till now, it's been very leisure oriented. Whether that be started off with drive to, now there's been a lot more fly to. We've seen air traffic really pick up. So, whether that drive to leisure has been tied to resorts or other locations can depend on where you really are. But resorts obviously have performed particularly well. Unfortunately, major convention demand has been sluggish. And that's because people haven't really been able to get together during the pandemic. You saw conventions canceled constantly throughout the pandemic. I think if we look at the metrics going back to 2019, 2020, we saw a massive decline, in 2020 in overall convention booking pace. And, we track the 30 largest convention centers around the U.S. So if you think about those as a good metric for large conventions and large conferences, 2022 is actually pacing up 95% over 2021. But that's still 16% below 2019 levels. So we're seeing a massive recovery, but it's still not where we want to be. 2023 and 2024 booking paces are only slightly below 2019 levels, and we think that will continue to improve. What ultimately happened is, as conventions got canceled in 2020 and 2021 related to the pandemic, those bookings ended up just getting pushed out. They weren't entirely canceled as much as postponed, and they were pushed out to 2022, 2023, and 2024. Unfortunately, during that period, you also didn't see a lot of new bookings occur because of the uncertainty surrounding the pandemic and how that would unfold. Now that we seem to feel the market seems to have some confidence that the pandemic is behind us, or at least to a large extent behind us, you're going to start to see more of those new bookings emerge. And while booking paces right now are a little bit below 2019 levels in 2023 and 2024, we wouldn't be surprised to see those catch up and be above 2019 levels as early as 2023. And to give you some perspective, normally we refer to convention demand as kind of the super tanker or battleship of the of the hotel industry. It doesn't move quickly, right? Usually once it falls, it takes a long time to recover because those bookings are very long lead times, usually several years out. So the fact that we're coming back as quickly as we are is a very strong indicator for where convention demand is going to be, and points to relative outperformance versus past recoveries, which is one of the things that we highlight, where we think this recovery is already recovering more quickly than we've seen in the past, and will continue to do so, which is very encouraging for hotel investors, hotel owners, and hotel operators.
Yeah, and when you start using boat analyses, Ron, I mean, examples, you've got my attention. I like that. I like that.
All right.
That
I'm
they
glad you
can
like the
move.
super tanker.
What about? I'm going to ask you about just a couple of the larger markets to kind of get an indication there. What about New York City? How's it doing?
Sure. So I think what might make sense is to kind of start with our worldview, and then we can drill down into New York. So our worldview is relatively positive. We generally think that occupancy this year is going to grow about 4.4%, break 60% to a 60.2% level. That's still about 9% below where we were in 2019. ADR, we're very positive on ADR. We think ADRs are continuing to surprise to the upside. We've got one of the most positive outlooks for ADR out there. We're expecting ADR this year to be at 141.38, which is up 13% from last year, and up 8% over 2019. So we're already back above 2019 levels. RevPAR, as a result, will be around $85, up 18% year over year, and only 2% below 2019 levels this year. And perhaps more importantly, we expect EBITDA to be up 57% this year, which is only 15% below 2019 levels, and hotel values, to be up about 12% this year, and be 4% above 2019 levels. So we've already recovered to pre-pandemic valuation levels.
That's
When
that's
you think,
strong. That's
when,
strong. Very
yeah,
strong. That's exciting.
exactly. And when you think about it and there's a lot of factors that go into that. A lot of it is the capital chasing hotel deals. A lot of it is inflation, and the idea that hotels are more inflation resilient than other property types. There's a variety of factors going in, but ultimately we remain very encouraged. And if you look at some of the transactions that have occurred, we've seen more $2 million plus per key transactions in 2021 than we ever saw before. We've seen more $1 million plus per key transactions in 2021 than we ever saw before. So there's, at the high end, things are moving pretty well. There's obviously some challenges in certain markets like New York, and we'll get to that in a second. But I think also what's helpful is, as we mentioned, we think ADR is basically back to 2019 levels already. We expect values to be back this year. RevPAR and hotel EBITDA, it'll be next year, 2023. And then occupancy, which is kind of interesting. We expect occupancy to stabilize below 2019 levels. 2019 was around 66%. We think occupancy this cycle will get to around 63% in 2023, and that's where it will stay. And part of that is driven by our view that corporate transient demand isn't going to be quite as strong in this cycle as we've seen in the past. Not that it's negative. I don't want to highlight that as a negative. It's just, the reality is, if we're going to see more what we call a flexible work environment, where people aren't in their office 5 days a week, you're going to see, instead of 3 or 4 nights a week of corporate transient travel, it's going to be more like 2 or 3, focused on the days that their clients are in fact in the office. And as that happens, it will reduce corporate transient demand. Now, the good news with that is you're going to have more corporate transient demand on specific nights of the week, which will increase pricing power and compression. And the other good news out of that is it will create more long weekends for leisure travel for Thursdays through Sundays. But ultimately, it will impact overall demand, which is why we think occupancy stabilizes a little bit below historical peaks. That being said, when you think about New York is actually out of the top 26 markets that we track. That's STR's top 25, plus Las Vegas. Las Vegas is kind of important for the hospitality industry. Why STR doesn't track it, you can ask them. But it's kind of important. So we follow the top 26 markets on a quarterly basis. And of those 26 markets, New York is actually ranked dead last for us in terms of value recovery. So it's a market that we think is going to continue to face challenges. Now, the good news with New York is we actually think we don't see value erosion from current levels. We think values have probably bottomed where they are. They're just not going to see any growth. And that's driven by a few factors. One, international demand is slower to recover. Corporate transient isn't going to be as strong as leisure or group. Group isn't as big of a driver in New York as it is in other markets. And then, more importantly, expenses. Wages across New York are a major issue. You've got huge union labor concerns, which continue to weigh on the market. And then you have a lot of supply. I'm not sure if you're familiar, but the city council and Mayor Bill de Blasio, before he left office, basically put a new addendum in place in the Planning and Zoning Commission that basically makes any new hotel that hasn't already started construction as of December of 2021 to now have to go through a special permitting process to get approval for construction. That special permitting process will basically require union labor at the hotel. So it's effectively put a moratorium on hotel development. And what that did while that was going through the process is every hotel that was in planning and in the process accelerated to try to break ground and get grandfathered in. So you have a significant amount of supply coming online in New York over the next, call it 3 years as those hotels get developed. And it's going to take some time for that to work through. But once that's done, there's not going to be any new supply unless that law changes, something that we don't see happening anytime soon. As a result, it could get interesting down the road. But over the next, call it 3 years, we're going to see elevated supply, and you're going to still deal with massive labor challenges and expenses, which is why we're cautious on hotel values in New York.
Yeah, and in not only New York, but all over the country, right, have labor issues, but especially the demands that the mayor put on the industry there. And you mentioned Vegas. What's going on out there?
We really like Vegas. We use Moody's Analytics, Mark Zandi's company, economy.com. It was bought by Moody's a few years ago as our market level for economic forecaster. And they've actually got Las Vegas as the number one market for economic growth over the next 5 years across the US. So strong economic growth is going to be very positive. We've talked about the pent-up leisure demand. That is very real. We've talked about the strength in group, where we're going to see, because you're going to see less corporate transient demand, people we think will be in more flexible work environment. There's going to be more reason for corporations to get their people together because they're not going to be in the office as much together. And as that happens, that's good for group, which is good for Vegas as well. Vegas is one of our top markets for RevPAR growth. It's still a union market, so you've got expenses and some of those challenges tied to that market as well. But ultimately, it's a market that we like a lot.
Interesting. Well, you've mentioned values kind of coming back in a lot of these markets. What are you seeing for cap rate trends?
Yeah, I mean, hotel cap rates are kind of an interesting dynamic, right? We estimate that in 2020 values dropped around 24%, but hotel EBITDA dropped 95%, right? So did cap rates really compress to, 1% levels? Probably not. I think at the end of the day, hotels in the current environment have to be valued based on some level of discounted cash flow analysis, or you're benchmarking to a 2019 level as opposed to current cap rates. So what you see in terms of cap rates can be misleading related to hotels. I think if you look at current cap rates or in-place cap rates today for the hotel space, that's more of an output than an input of valuation, if you will. And you're looking much more at a DCF or relative to 2019 levels. What I can tell you is relative to 2019 levels right now, what you're seeing is cap rates that have slightly compressed. Moving forward, we expect modest expansion. Our forecast for the U.S. cap rate expansion is about 20 basis points over the next 5 years, because while we expect base rates to go up meaningfully, and we've got four 4 rate hikes built into our models over the course of 2022 alone. To give you a sense, we think the spread between base rates and cap rates and hotel cap rates will compress. That's historically what we've seen happen. That's partly driven by inflation, which actually has historically had a positive relationship with hotel cap rates. As inflation goes up, cap rates actually compress, or cap rate spreads compress, which is a positive for hotels. The other side of that is just the amount of capital that's out there chasing hotel deals, where we really believe that you're going to see those spreads really compress because of that. You put all that together, and and our cap rate model includes a variety of different factors. We look at foreign exchange rates, we look at economic activity, we we look at supply, a slew of metrics that go into our model. But at the end of the day, we actually only see cap rates expanding roughly 20 bips relative to 2019 levels over the next 5 years.
Yeah, well, that's interesting. I was at an event last night talking to a lender I know, and he was so excited because they were doing a loan on a new hotel construction. So, it's exciting to see kind of new supply and lenders excited about putting debt on these properties.
I'll tell you, we do a lot of work for specific deals for our clients, whether they be deals where a client is looking to buy a hotel or develop a hotel, and they want kind of market level benchmark forecasts and things like that, sub-market level granular detail. And we have been so busy over the past month. It's crazy. The number of developments that we're working on is off the charts. And it highlights that even though fundamentals aren't where we'd like them to be, the trend line is pretty encouraging. People are feeling good about it, and access to capital is plentiful right now for hotel deals. So you're going to see more and more of that.
All right. Ryan, what would you leave our audience to think about moving forward?
What I'd leave the audience think about is, as you think about the hotel business, what you've historically seen is, market timing is a difficult thing to think about, right? It involves two different components: buying at the right time and selling at the right time. If you get one of those right and the other wrong, it doesn't work, right? You have to get both right. So, what I can tell you is I don't know when the right time to sell will be, but at the bottom of cycles is the right time to buy. If you look at it from 2011 to 2018, values increased close to 50% across the U.S. We're at the bottom now. So this is a great opportunity. Now, I'm not going to sit here and tell you values are going to grow 50% over the next 7 years. That's not our view, because we think things have already recovered so much. Last year would have been a better time than right now, but you're still going to see real growth. And when you look at that real growth, the other thing I'd highlight is that understand your markets. Every market is not created equal. Different markets are going to perform particularly well. We talked about New York as an example of one that we're really pretty cautious on. San Francisco is another one that we're really pretty cautious on. But if you think about over the next 5 years, where we've got values, relative to 2019 levels, markets like New York, San Francisco, and Chicago, we think are going to see values that still don't get to within 10% of 2019 levels. But then if you look at markets like Tampa, Los Angeles, Phoenix, Nashville, Denver, those are markets that are all going to see values that are 20% above 2019 levels. So understanding your markets and knowing the nuances and the drivers of the different markets is really helpful in terms of determining where you want to invest.
Yeah, great advice and good information. Ryan, thank you for joining us, sir.
My pleasure. Thanks for having me.
Yeah, if you like more information from them, check them out. They're Lodging Analytics Research and Consulting. Their website is LARC Analytics.com. And thank you for joining us around the country. Please let us know what you think. We appreciate you reaching out, and we appreciate you sharing the show. So until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert level commercial real estate broker training. Cloud Access 1, up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.